What's going on, guys? Back with another one. We're gonna go ahead and finish up these core concepts, or at least like three more. So like five, six, seven, eight. So like four more, and then 9, 10, 11 I can do tomorrow. And just really getting through it. So this is gonna be our favorite section right here: daily swings, highs, and lows. Here we go.
Our next topic, daily swing highs and lows. Daily swing highs and lows. Now, every turning point in the market forms a swing high or low. On a lower time frame, this might seem meaningless. However, if we use a daily chart and we see this form at a key level, and importantly, we also still have a draw on liquidity present, this becomes crucial and we can frame an entire model behind this idea. So over here we got a US dollar index daily chart. Now first of all, what is a swing low and what is a swing high, right? Over here we see a swing low. With a swing low you want to have three candles next to each other, right? One is higher closed than the middle one, and to the right of it, it should be higher closed than the middle one. So we've got one higher, one lower, one higher, and then we have a swing low. So over here we've got a swing high, right? So one candle to the left is lower, one in the middle is higher, and to the right of it, it is lower. So anticipating high probability price moves with swing highs and lows, we need to see them form at a key level. So if we are bullish, we want to see a swing low form at a discount array and or after running another swing low. And if we are bearish, we want to see a swing high form at a premium array and or opportunities using the daily swing highs and lows. And the easiest model you will ever have is the day after that 3-day swing bar pattern has formed. So we're going to focus on day number 4 after that swing high or low has been formed. We can also focus on 2 days after that 3-day swing bar pattern has formed. So 2 days after that swing high or swing low has formed, or day 5. So once the 3-day swing pattern has formed at a key level, we can look for day 4 to run previous daily high or previous daily low, right? So after that 3-day pattern. Furthermore, if day 4's body, right, the fourth day after that 3-day swing pattern has formed, if that fourth day body's candle closed above bullish or below bearish, right, we can also aim for previous daily high or previous daily low if the draw liquidity is still intact. So then all we have to do is work with the understanding of the open high low close or the open low high close, right? Taught in that first lesson of the mentorship. So this is hands down the easiest model you will ever have. You may not find a high probability trade on one pair every week, but within a basket of a few pairs you will find one high probability trade every single week using this model. All you need is one trade a week to make a living of trading and pass all funded accounts you want. Right, so over here we've got a crude oil futures chart, a daily chart, and again we're gonna focus on that fourth day, right, after that swing pattern has formed. So we can see a swing high form up here, right? We've got another swing high formed up here, and notice how this is formed in a volume imbalance, right? So we've got a premium array over here, and we've got another swing high formed over here, and we're focusing on that fourth day, right? And notice how that fourth day every time almost is a big candle, and it goes into our draw on liquidity. So now after we focus on that fourth day, we're going to use our understanding of that open high low close, or that power of 3, right, from lesson number 1. So here, is it in a key level? Yes, it is in a key level, right? We got that daily fair value gap filled your open high opening price, right, over, and we want to see, and then we're aiming for that draw down into our draw on liquidity form at a key level, right? So over here we've got that swing low formed, right? Is it happening at a key level? Yes, it is,
I'm
right? Because we
really
got that
just
daily
interested
discount fair
in
value
the
gap. We've got this
day
discount
trading
level and that
aspect,
fair value
because
gap formed
this
down here.
swings is
Now
not
we're going to
working for
focus
me.
on day number 4, right? That's most high probability to run
Excuse
that
me.
previous daily high after that swing low formation has formed. So over here we've got day number 1, we've got day number 2 hitting that daily fair value gap in discount, and then day number 3 forms that swing pattern, right? And now we're gonna focus on day number 4 because that's highly likely to run previous daily high. So we got an easy draw on liquidity, and we're gonna use again our understanding of the power of 3, right? That open, a low, high, close of the candle. So how does that look like on an intraday chart? We've got that Euro British Pound 15-minute chart right now. Day 1 down here at a key level. At the key level time frame, we have the draw, those filled daily. We're gonna use, got that higher. And again, we're focusing on day number 4 and day number 4. So we're going into buy side.
All that is going to be great if you're a swing trader once we have some capital. But for right now, we got to find something that's going to stick with us. I'm going to just breeze
The next top
through and
falls into a
see.
daily structure. We're gonna be using understand. Between these two is the foundation to building the anticipatory skills for price movements and understanding where the market is likely to draw to. Now, what is internal and what is external range liquidity? Internal range liquidity, or IRL, is defined by fair value gaps, so imbalances on your chart. External range liquidity is defined by old highs and old lows. When external range liquidity is taken, a fair value gap becomes the next draw on liquidity, and when a fair value gap is stacked, an old low or a old low again. And when a fair value gap is stacked, an old low or an old high, external range liquidity becomes the next draw.
This is very important. So I'm just going to repeat what he says, probably in like simpler terms, but when the highs and lows of the day, which is defined by the external range liquidity, it takes a fair value gap, it becomes an extra. And then when the fair value gap is tagged in the old lows or highs, it becomes an extra. So that's just the difference between internal and external. I'm still learning it as it goes. I thought it was out cooler in my head, to be honest.
Now we have a crude schematic over here on how to see where internal and where external range liquidity is. We've got this move up starting from here. So we have external range over here, which is an old low, right? We move up, going down, 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 taking out that low. So that is external range liquidity, right? Because there's an old low down here. Now, price only does two things, right? It goes to old highs and old lows, or seeks to reprice into imbalances. So in this range where we draw lower from, there was a fair value gap or an imbalance up higher. Price took out external range liquidity. So what is the next thing price will do? Price will draw to internal next, which is that fair value gap. So think about it, when you see a old high or a old low get rated, you want to either look for an imbalance inside that range to get repriced into, right? And then once that gets hit, we can move for the next one, which is external again. Same over here, only reversed, right? We have external range liquidity over here, as in an old high. Price moves lower, forms a swing low, expands up higher, taking out that external range liquidity. In the process of taking out that external range or old high over here, we form an imbalance down here, which could be a fair value gap.
So basically, when external range liquidity is taken, boom, you wait patiently, wait patiently for the setup. When price gets into the fair value gap, that's when you want to see if it's going to reject the fair value gap, if it's going to push past it, or if it's going to go down. And then based on price action, you'll see, and then it could just either shoot up or shoot down.
Then price moves back into that fair value gap after taking out external range liquidity, right? And then when we hit that internal range, we want to go for external again. As explained earlier, price only does two things. It draws to old highs and old lows, and it rebalances an imbalance. So there's literally nothing else price does. And with that in mind, it becomes very clear after you see old highs or old lows getting rated, What are we going to look for next, right? We're going to look for an imbalance where we can trade into. And let's say we are in bearish order flow and we take out an old low. There's probably a fair value gap in a premium level on that same structure. We can look to trade and buy into that old internal range liquidity being tagged will be the catalyst for price to draw to external range liquidity, and vice versa. And external range liquidity being taken.
I really don't like hearing him talk, so I'm gonna say price only does two things. The flow of the marketplace is that internal range liquidity being tagged will be the next catalyst for price draw to external range liquidity. And external range liquidity being taken is the catalyst for price to draw to internal range liquidity. So once internal range liquidity is taken, then it will draw. You can draw it at the external range liquidity. And when external range liquidity is being taken, which is getting beat down, that's a catalyst for you to draw into the internal range liquidity, which is that fair value cap that people see. Boom, take that, shoot up, and or shoot down. Simple as that. And you can use it for all time frames, monthly, weekly, daily, and 4 hours is the key. Or to stick to the 4 hour.
Taken is the catalyst for price to draw to internal range. So it's only understand over here. Now let's look where is the monthly external range liquidity over here, right? So we rate this external range. Now, without going further,
This is the fair
where does
value
your
gap
eye
right
draw
here.
into? You should be looking at a internal range liquidity in the form of a fair value gap, right? So after external gets rated, where do we want to reach into? We can see this
Boom.
imbalance down here, which is
Yes,
a fair
sir.
value
We're
gap,
learning.
right? So what happens afterwards,
Then it shoots up. We're gonna see if it rejects or not.
right? Let's look at this from a daily perspective,
Excuse me.
right? We take out a monthly external range liquidity. Now, using daily structure to frame our setups, what are we going to be waiting for? After this monthly external range liquidity structure, that happens. So your eye should immediately go to that bullish fair value gap below market price as the next drawn liquidity. Because external range liquidity being taken is the catalyst for price, your understanding of price, and where it's like a monthly chart, you've got a
Get that.
GBP, AUD.
Okay, so boom, external range is taken. And then we look for the fair value gap. Let's see if we find a fair value gap. Right here, just barely. It's a very small one. Actually, right here and right here, kind of. Price is kind of bouncing, so like right here. Actually, no. This usually wicks right here. I'm sorry. Yeah, this is the fair value gap right here.
The weekly chart over here, again, imbalance being present down here, this fair value gap, your
Oh,
eyes
I'm
should
tripping.
immediately, right? Weekly internal range liquidity. Liquidity gonna go to external. It's simple as that. Internal, and looking at the daily chart, now we can see how we can frame our buy model. So now we're gonna reach for external range liquidity. And the first
Nah, I
external
think I
range
was right.
liquidity, which is
Boom,
very
right here.
obvious, is this long wick
Internal
here,
value gap.
right? So we're gonna eye it. So liquidity will be taken. This keeps going internal. Again, back into external, to external. Is the draw on liquidity, but with using.
All right, this is the external draw of liquidity taken down here. So, boom. I'm guessing this was previous day, current day. Boom, boom. The fair value gap is right here. So, once this is taken, that this will be where you want to set your sell order. Boom, that and or right here. Boom.
External to internal and
Let's see if that was right.
liquidity. Again, we want to go to internal range, right? So where is internal range liquidity? We've got this big fair value gap up
I'm
here.
tripping. Am I
Price reprices back into that imbalance over here. So we hit that internal range liquidity. What do we want to do
I'm
after we
tripping.
take internal range liquidity? Go back to external, right? We fill this
I
up.
forgot it's flipped,
We
so
look
that
for
kind of
this
confuses me just a
lower,
little
going
bit.
back
But
in price into on here, external range liquidity, which we're probably gonna go into external range once again. And we're gonna go for that. You can also go from internal range to external range, which could be is the key that unlocks your understanding to
Let's see, summary, the relationship between two U's on a monthly and the basement low resistant liquidity runs that they're only fragile patterns on the chart. Trend lines are equals high or equal lows. That is valid, blase, blase, blase. Basically, this is what a lot of traders use, including TJR himself, other traders using that fair value gap. Let's go into order pairing.
in this next lesson we're going to, however, you abandon it just for price to event
HTF, turtle soups, and liquidity engineering, understanding the liquidity requirements smart money needs for their orders, when they can get in, how they get out of the positions, a crucial fundamental understanding that is required to trust the market to deliver to specific levels, to understand where and why it's reaching for that specific goal. Believe price going for reach for a level, however, you just abandon just for price to get the desired, blase, blase. Third, retracement, thinking is reversing, not trusting is a lack of understanding liquidity requirements of how the market makers will engineer liquidity for their order pairing. This is exactly how I lost a lot of my money. The urge to get out the market on a retracement, thinking it's reversing. I'm thinking it's reversing, and it's really not. And I'm not trusting in delivery. I'm not believing in my trades, and that's how the market makers are gonna just straight dig me out,
eventually get to your desired location.
dig me in.
Requirements. We use a weekly PD array with a
Hey,
4-hour structure. So it's more of a that's, and when they are bearish, they will accumulate their sell.
smart money are involved in moves on the monthly, weekly, daily time frames. Below lows, below lows when bullish, above highs when bearish. If you're not trading off HTF level, you are gambling. You're right, I was gambling. Let me search what ATF means. HTF means high frequency trading. Means taking place in time intervals ranging from hours to microseconds and the volumes traded. Okay. High frequency trading. So basically, fast markets is where we're really getting into. You're not trading by that.
Above the order flow right now. And so here we have a daily structure, and we have those monthly levels annotated also, right? So we have this, you are correct, because this is external range, right? An old low. Where are the orders being paired up with sell this position or willing buyers
Again,
up
this is
here
for swings and
above
everything.
liquidity?
It's not for the
We're going to be
days.
looking for that as a target.
Tracements.
So same chart
You would
again,
think it will
British
retrace
pound,
here.
Canadian dollar, daily chart. Smart money accumulates orders down here, liquidity over here. We are free. So order pairing into bold low, and liquidity accumulates their sell orders, right? So what do we do after we go from external? We go into internal, right? So where is our internal range liquidity?
Boom.
We've got this fair value gap here.
We got one here too, though.
But can you see something else? What are we seeing in this piece of price action over here?
This is order block
Because we
right
want to
here.
look for an opportunity to get. We've got this failure swing daily chart, right? So we were breaking structure that we did over here. It's going to be below an old low, which is where smart money are accumulating long position.
This one's cool. Let's go order blocks.
Next topic. And what are the close candle that pushes price into buy stops?
So what characteristics do high probability order blocks have? Format key level bullish order blocks with the short term low liquidity pool above it. Bearish order blocks with the short term high liquidity pool below it. They push price into a liquidity pool, causing a purge on stops, and up close candle that pushes price into buy stops when bearish, or a down close candle that pushes price into sell stops when bullish. Bullish order blocks in a buy program to support price higher to draw on liquidity above market price, and bearish order blocks in a sell program to support price lower to draw on liquidity below market price. And I was seeing a great example of this earlier today. Live NQ trader, I forgot his name, Asian guy. He goes live on YouTube. He was just talking about this. When it goes all the way high, it just has a high candle. So when you put sell orders, and then when it dips back, take your profit. Boom. When it dips back down and it still has those high candles, high liquidity, boom. Buy orders, shoots back up.
When bearish, or a down close candle that pushes price bullish to support price lines to turn down lower. Again, time frame aligned, 5 minutes with the Canadian dollar chart, right over here. Buy stops have been rated. So we have this order block over here, right? We take out buy stops, and then price continues to break probability order block only on a lower time frame. Range, we go to internal range, right? We see this again, taking out buy stops over here.
This will not help us in our day trading journey, man. IPDA.
Next up. So what does IPDA stand for? So
Yeah, this is perfect. Retracement, reversal, consolidation, expansion.
IPDA stands for Interbank Price Delivery Algorithm. This is the algorithm which makes the market move a certain way. And this algorithm has certain cycles. So over here we have this price delivery depiction. We're starting with retracement, we've got reversal, consolidation, and expansion. Price only has 4 stages and it's always doing one of these. There's nothing else it does. So we have that consolidation, that expansion, retracement, and reversal. Now we're gonna depict what it can do and also importantly what it cannot do, so you can anticipate in which cycle it is, and if you know what it shouldn't do, then you have a higher probability of framing your trade setup. So over here, firstly, price always goes from a consolidation to an expansion next. Price can go from an expansion into a retracement. Price can also go from an expansion into a reversal, and price can also go from an expansion into a consolidation. Now, what price never does is go from a consolidation into a reversal, and we'll outline in the charts later how that looks like. And price can never go from a consolidation into a retracement. When price looks like it's delivering a consolidation to reversal, it's a trap and you will be followed by an AMD reversal pattern. So if you're not familiar with AMD, it stands for accumulation, manipulation, and distribution. So you can already see in the name AMD, we've got that manipulation. So think about what we just said, right? You cannot go from a consolidation into a reversal because consolidation is accumulation, right? The A in AMD, but we cannot go into a reversal from a consolidation. But if we do trade, let's say we are bullish and we have a consolidation and price starts to go lower, reversing from that consolidation, which it cannot do, it's a manipulation, right? For us to continue higher later, which will be the distribution phase, and we will outline those in the charts coming up.
All right,
Once which
understand is we gotta
up
go to the
higher.
charts.
So if we look at this consolidation, can we reverse from this? We have a break of structure over here, but no, we are not reversing from this. Why? Because we have the liquidity up here, right? It shouldn't depiction of that accumulation phase, right?
Manipulation,
The manipulation phase below
down,
sell stops,
boom,
right? Order pairing, again, external range liquidity, then distributing up higher in the process, expansion from the consolidation, or right over here, never do after consolidation.
Go down.
It never reverses, right? So if we were to move down lower than this, right? But if it does move a little bit lower, we can see an AMD model form, which reject over here and not reach the dimension. Failure swing, right? So we have a draw on liquidity. We have a break of structure. Look at all these failure swings down here, right? sell stop down structure lower and move up. It is do this. Now continuation from a consolidated market cycle to buy side of the reach yet.
You
So
cannot beat the market trends. Boom, boom, straight up trend.
it has to do a expansion into the Canadian, the order block. Then we run. So what do we need to do? We need to trade lower.
That's cool. Let me see. Breakaway.
It's time the redelivered, rebalanced PD array. So identify down. Now we've got this nice depiction of how it looks like.
Now, I don't want to tell you that this is not all important. It's just not going to be of to value for us as, you know what I'm saying, day traders, unless you're looking at it from bigger out aspect and you're planning on what days to trade. But if we trying to get some money, we got to get money every other day. Like, I mean, got to pick our days wisely. You know, some days have news and stuff. So it's a big market, but you know, we'll figure it out slowly.
Like with Ken again, so a bearish rebound. So this fair value gap will stay open. Oh, this is this. There is a fair value gap here, but it is a breakaway gap. Now, why is it a breakaway gap? We just learned about this new PD array, right? Price range over here, up, down, and then we delivered rebalance. Australian dollar U away gap now drops or drop. We've got
I have nobody talking about breakaway gaps like that. It's always fair value gaps. Let's see this one.
So we've reached the final lesson of those exotic pairs and how to do relative strength analysis on the currency. Now, when is it most likely that the dollar index will consolidate? When it is at equilibrium of a higher time frame range, when we have high impact news late in the week and none early in the week, three major high impact US news events such as NFP, CPI or FOMC, in London session when the Asian session was extremely large, and then in New York session when London session was extremely large.
That was similar today. We had consolidation period the whole day, basically today, and boom, London session probably had a big range.
For signatures in price to tip its hand to us that consolidation scandal is an inflow, and failure to do so will result in a day 1 hour draw on liquidity for those individual currencies. So DXY consolidating, then it extends into consolidating currency. And order block over here, and we can see Thursday and Friday is reacting.
Can't do that with a funded account, bro.
So dollar daily chart, previous lesson up this bullish order block. Euro GBP is bullish, then the euro, we've got sell side of the curve until this bullish price is still.
I'd say the most we got out of this was straight up, you know, fair value gaps and stuff of that nature. So that's what we're gonna stick with, and that's what we're gonna end off with, guys. You know, hope you guys have a good one. You stay locked in. We'll get back trading Monday as soon as we get 2 new funded accounts. Let's go.